Last week, mortgage rates dropped to the lowest they've been all year long yet again, thanks to the BLS jobs report that we'll cover here in a minute. And as a result, we saw a huge 9% increase in the number of people applying for mortgages last week, and this actually makes for 5 consecutive weeks of positive growth year over year. Overall housing inventory saw a small increase nationally, but new listings saw a huge increase of over 10,000 more listings than last week. Both Dallas and Collin counties continued heating up, and we can expect that to continue from here until about June. We're covering all this and much more in this week's market update. My name is Michael. I'm a real estate agent here in the Dallas-Fort Worth area, and every Monday I give you a weekly update covering all of Dallas and Collin counties as well as the national market. We're looking for trends. We're tracking mortgage rates as well as mortgage purchase applications, as that's our best leading indicator to what demand will look like 30 to 90 days from now. We're looking at things like median list price, days on market, how many homes are having price decreases, what's inventory looking like, and if you stick around until the end, it's my favorite part, the top 10 ranked hottest and coolest cities and zip codes in all of Dallas and Collin counties. If this sounds like something you're into, make sure and hit the subscribe button. And if you're looking to buy, sell, or invest here in the Dallas-Fort Worth area, whether it's next week or next year, I'd love to connect. I've helped every one of these yellow dots find their little piece of Texas, and I'd love to help you too. Just call, text, or shoot me an email. All that info is in the description below. Okay, today is March 10th. Let's see what the data is telling us. And if this is an old video, you can click the playlist here to get to the latest weekly market update. Let's start with market news. Last week, we got the latest BLS jobs report. And these are always a very big deal because at this point, the Fed cares much more about labor data than they do inflation. And so far, since COVID, unemployment has just been way too low for their taste, meaning too many people employed making too much and ultimately spending too much money, which they fear is going to lead to more inflation. So they don't like that at all, and they want unemployment to be going up so that there's less money coming into and being spent in the economy. And they've let us know their target unemployment rate right now is 4.3%. So if you want lower mortgage rates, what you're actually hoping for is for unemployment to climb above 4.3%. And in this latest jobs report, we learned exactly the same as what we've been seeing the last many reports, that the labor market is softening without breaking. In this report, total non-farm payroll increased by 151,000 jobs in February. This brings us to an average of 138,000 new jobs every month so far this year on average. The unemployment rate also had a small increase from 4% up to 4.1%, which doesn't sound like much, but remember, the upper limit is only 4.3%. Looking at the chart here, you can see unemployment generally moves very slowly, and this of course is a good thing. We don't want anything breaking. We like nice and slow, but you can see ever since COVID, the highest it's been is up here at 4.2, and it was there as recently as November of last year. Then we spent the next 2 months going the wrong direction if you want to see mortgage rates drop, down to 4% last month, and then now we're right back up to 4.1. So at least we're headed back in the right direction this month. We're only 0.2 away. This could happen in a couple of months. But a few things to notice about this chart is you can see we've been well below 4%. Look at this. All of this time, we're well below 4%. We finally got back up to 4 just in May of last year. And this is why the Fed hasn't been seriously cutting rates, because it certainly would have led to more inflation with this many people employed and dropping rates. And remember, even a 4.3% unemployment as their target is a very low bar, which is a good thing. What they're doing is communicating to the bond market, hey, if unemployment goes up even a tiny bit from here and gets above 4.3%, then we're going to cut rates. So if rates do get above that 4.3%, then the bond market knows how to react. The 10-year will drop, so mortgage rates will drop, because the bond market knows if that happens, the Fed has told them it will finally get serious about cutting the federal funds rate. Now, the two biggest factors right now that could get us over that 4.3% unemployment are, one, can the private sector absorb all of the coming job losses from the federal government? And we talked about this a lot last week with DOGE looking to cut a bunch of federal government jobs, as well as just cutting overall funding of a lot of different things, which would lead to further unemployment because they can't pay their employees without the funding. So that's one big factor that we really have no idea where it's going to end up at this point. And then number 2 would be layoffs in the residential housing market. Home builders are losing confidence in what the market is going to look like moving forward, given that rates are still too high, and now they're going to be battling potentially with these tariffs, which could raise all of their supply costs, but especially lumber costs, which houses take a lot of lumber. So there's a lot of uncertainty around both of those things when it comes to home building. This is the latest builder confidence survey that we have, but I want you to see there over the next 6 months outlook, you can see a huge sharp drop over the last 2 months. So builders have very little confidence in what the future is going to look like for them. And keep in mind, as quickly as it dropped these last 2 months, their confidence could come right back if rates were to drop or things were to improve, tariffs were to be reduced, anything. So don't get too scared by this, but the point is, you do not want home builders slowing down building houses. As we've talked about many times, mass layoffs, specifically in the residential home building sector, have historically been a leading indicator of a greater job loss recession. And you can kind of see that on this chart here. This is the number of residential home builder workers, construction workers that are employed. So you can see it starts with cuts way back here, and then the recession hits here in the dark gray. You can see it again here. The layoff started, then the recession was here. The layoff started, recession was here. And COVID, obviously, all of the numbers were weird. So we don't have the layoffs yet, but if they start to happen, then you can know we're probably headed for a greater recession. And it's actually pretty remarkable that given how high rates have been for so long, that builders have actually been increasing their employment for all of these months. So we're still not even headed down at this point. But of course, if builders' confidence tanks and they stop building homes, this can all turn pretty quickly. Which of course, those layoffs would then ultimately bring lower mortgage rates, which would cause builders to start building again. But if this happens, then that means mortgage rates are going to be dropping while new construction supply is low because they've stopped building. Because building houses takes a long time. You can't just turn it on and there's more houses. You got to start the whole process over with permitting, with building. So what you would have at that moment is a big increase in demand from low rates, along with a big decrease in supply because builders will have stopped building. And as you know from the law of supply and demand, this would mean home prices going up significantly. So we don't want any of that. And hopefully things keep moving at the nice, slow, steady pace. And hopefully we're going to just slowly climb over that 4.3% unemployment with nothing breaking. But we're currently at an average of 138,000 jobs created per month this year. If job growth slows below 133,000 jobs per month, then some combination of the government layoffs, or we get some housing construction layoffs starting, plus just the normal slowing of the economy that's intended to happen from these high rates, any combination of these things can pretty easily get us above that 4.3% threshold for the Fed. Because again, they've set a pretty low bar intentionally. They don't want employment to get out of control. So I think it's pretty realistic we get there this year, and when it does, that's when we should see a meaningful drop in mortgage rates. And then of course, in my opinion, once mortgage rates actually get and stay below 6% for a sustained period of time, we're gonna see a lot more home buyers coming into the market. Okay, moving on, for those of you that missed it, last week I finally made an updated investing in new construction video. These things are so much work to make, so I typically just make one for the year. But if you're considering investing in the Dallas-Fort Worth area, specifically in new construction, which in my opinion is the better way to invest, then you have to watch this video next. I give you all of the data for the top 5 markets people are always asking me about. I'll show you exactly what kind of home you would be buying in each area with a full walkthrough tour. I show you what the areas look like, how long you could expect it to take to rent your home out, what all the numbers look like, and even help you project future profits looking at what's happened over the last decade. So if you're considering buying a rental in Dallas-Fort Worth this year, make sure and watch this entire video first and then give me a call. Okay, moving on, let's start with national housing inventory. This week we had an increase of 2,874 more homes for sale in the country. This raises us 2% up to 28% more inventory than we had last year, to a total of 642,359 homes available for sale in the country. This same week last year, inventory was only at 500,359. So way better than last year. Then for reference, the all-time inventory bottom in 22, we only had 240,000 homes for sale. The peak of last year, we had about 739,000 homes for sale. This same week in 2015, for reference, we had about 1,081,000 homes for sale. Now looking at new listings, this week we have 4,615 more new listings than we did last year, and that is a huge jump this week of 10,464 more listings than what we had last week, for a total of 63,858 new listings this week. This is great news. More and more people are listing their homes again, which means more inventory for you to choose from and less chance of prices running up quickly when mortgage rates finally drop. Now, looking at pending sales, this week we have 3% fewer sales pending than we did last year nationally, and we're basically just tracking right on with 2023's numbers. And then of course, Dallas and Collin counties, we actually have a lot more pending sales because we are the #1 fastest growing metro in the country, but nationally, sales are down a little bit, 3%. And then of course you can see we expected a slump this week, but this week we had 323,456 homes pending in the country, which is just about 2,400 less than we had last week. Then the last thing we cover nationally is the percentage of homes having price decreases. Every year it's normal for a third of homes to take a price cut before selling. Looking at the national chart, we had a very small decrease this week to 33.6% of homes taking a price cut. The only thing I ever want to say about this chart is don't think just because we started higher this year that means we have to end higher. As you can see, in all of these years, they started going up in pretty different places and they reached pretty different peaks. So there are so many factors going into this, but all you really need to know is if you want home prices to be coming down, this number has to be going up, as well as we are around a totally normal number right now. But just to reiterate, you can see the last 2 years, it started going up way earlier last year than the previous year, but both peaks ended up around the same. As well as in 2022, we got way down maybe to 25%, and then we ended way up at 43.2%. So don't think just because we're starting here, this has to go straight up. That's all I'm trying to say. But right now, we're at a totally normal number. Okay, looking at mortgage rates, we started the week last week at a 6.74. We got as low as a 6.70, which is the lowest that we have been the entire year. And then we had a little bounce at the end of the week up to 6.79%. But as you can see, at the start of the week, we were actually 0.4% lower than we were the same day last year. And then of course, with that bounce, we only ended up 0.13%. But either way, mortgage rates are lower right now than they were a year ago. And then as I mentioned regarding mortgage purchase applications, we actually saw a 9% increase in the number of people applying for mortgages this week due to that big drop down. And this actually makes for 5 straight weeks of positive year-over-year growth. So there are more people applying for mortgages this year than last year. But I've been saying it for more than a year, and I'm gonna keep saying it. Real mortgage demand does not come in until mortgage rates get and stay below 6% for a sustained period of time. That's the only thing that's gonna get us even closer to a normal market demand. And the evidence we have for that is new construction has been offering below 6% for a long time, and they've been selling way better than pre-existing homes. Okay, moving on to the local markets, starting with the MLS data of Dallas County. This week we had 656 new listings, which is 7 more than last week. This is a lot of listings, that's good news. We had 317 closings, that's 30 less than last week. Of those closings, 65 were immediate sales, meaning they contracted within the first week. That was 4 less than last week. We had 323 new contracts, which is 4 more than last week. And in total, there are 2,114 homes either under contract or in pending status. That's 29 less than last week. Then moving on to Collin County, same thing. This week we had 566 new listings, which is 100 more than last week. And this is a huge difference starting the year with just 235 that first week all the way up to 566. So a lot of new listings growth in Collin County. We had 223 closings at 71 less than last week. 43 were immediate sales, that's 11 less. We had 200 new contracts, which is 43 more. And in total, 1,832 homes either under contract or pending. That's 63 more than last week. Now we're moving on to the Market Action Index, starting with Dallas County. If you've never seen it, it takes into account all of this data, puts it into one easy to read graphic with a number. Anything at 30 or below is a buyer's market. Above 30, we're asking how much of a seller's market are we in? We're currently at a 38, slight seller's advantage. And mostly what we use this for is to see, are things looking normal or is anything looking weird that we should be concerned about? So first thing, you can see the Market Action Index. The market has been heating up since early December. That's the only unusual thing that we've seen, but it is normal for the market to be heating up now. And of course it is continuing to heat up. We're up to a 38.29 this week. Nice, slow, steady heating up as we head into the spring market. Prices remained totally flat last week. The median price of new listings came down a little, but realistically, this type of action is considered flat. The new listings actually are a little bit more up than flat, but the median list price, that I would say is totally flat. Average days on market came down a little bit, but the big number is the median came way down. So over the last, since February 14th, we've gone from 77 median all the way down to 63. So that of course is another obvious sign of things heating up. Number of homes having price decreases, that's remained pretty much flat. And inventory, there's not been any real growth happening here in Dallas County. So everything pretty much in line with what should be happening. We're heading into the spring market, things should be heating up, and they are heating up. So let's look at Collin County. Collin County, if you'll remember a few weeks ago, we were saying it should be about the bottom for prices, and it definitely was the bottom. We have been rising ever since. Again, doesn't mean we need to go straight up, but we're definitely climbing. So we found the bottom right when we should have found the bottom. So That's very normal. That's something that we like to see. We like when things are normal. Median price for new listings remains pretty much at the top of this range at $529,000. Their average and median days are dropping as well. They're down to 89 average and 56 medians. So they've been dropping from 77 on January 17th all the way down to 56 on March 7th. So again, days on market lower is an obvious sign of heating up. Prices going up is an obvious sign of heating up. Number of homes having a price increase. Now, this is higher in Collin County because a lot of Collin County is new construction, and every few homes that build or sell, they're gonna try and raise prices a little bit. So you're gonna see a lot more price increases as we get in deeper into the spring market. Their inventory as well, it went down, but it came right back up. So this is all just pretty much flat, no meaningful growth there. And their market action index is way more obviously climbing up. So they're not as hot as Dallas County, but you can see it's going up pretty quickly. So everything is very normal in Collin County. This is nice, healthy growth. And finally, it's time to move on to the top 10 ranked hottest and coolest cities and zip codes in all of Dallas and Collin County. These are all ranked using that same market action index number, and we are starting with the hottest cities. The absolute hottest city remains and has been for many, many months, Carrollton, Texas at a 48.79. Remember, 30 or below is a buyer's market. Followed by Lewisville at a 47.46. Then Coppell heats up one this week, Plano heats up one, Grapevine heats up one, Richardson cools off 3, Grand Prairie and Ferris remain, and then Allen heats up one, Irving cools off one. So these two switch places. Then we like to zoom into specific zip codes. The absolute hottest at a 52.98 is Plano 75093. Followed by Carrollton 75007, Grand Prairie 75052, Plano 75025, Plano 75023, Lewisville 75077, Carrollton 75006, Dallas 75234, Coppell 75019, and Richardson 75080. So if you have a home in one of these zip codes, you should be able to sell for top dollar. Now doing the same thing, but looking at the coolest cities and zip codes, the absolute coolest remains Blue Ridge at a 29.51, and actually we're down to just 2 buyers markets now. We've had as many as 4 or 5, but these are the only 2 below a 30. So Blue Ridge and Lavon remain the 2 coolest this week, and then Leonard cools off 3, Royce City cools off 1, Van Alstyne heats up 2, Sunnyvale heats up 2, Rockwall remains, Salina cools off 2, Nevada heats up 1, and Anna jumps onto the list at number 10 to become the hottest city on the coolest cities list, and then Prosper, which was number 9 last week, heated up entirely off the list this week. Then looking at specific zip codes, the absolute coolest is Grand Prairie 75054, followed by Rockwall 75032, Blue Ridge 75424, Lavon 75166, Leonard 75452, Royce City 75189, Van Alstyne 75495, Sunnyvale 75182, Salina 75009, Duncanville 75116. Remember, if you're looking to buy, sell, or invest in the Dallas-Fort Worth area, whether it's next week or next year, I'd love to connect. Just call, text, or shoot me an email. All that is in the description below. Thank you for watching. I'll see you in the next video.